Good afternoon, ladies and gentlemen. It is afternoon, isn't it? It's good to see you all. My name is Brian Keegan. I'm Director of Advocacy and Voice here at Chartered Accountants Ireland. And it's my very pleasant duty this afternoon, to welcome our speakers and contributors to this event, but in particular to welcome you, our guests at Chartered Accountants House. I see lots of our members here. I see lots of members from the bodies we work with, because we do work with other professional accounting organisations. Chartered Accountants Ireland is in the almost unique position of having to deal with 3 governments on a good day, 2 regulators, but 1 cohesive membership on the island of Ireland. And that means that events such as these, they're not just about being talking shops, they're not just briefing sessions, but they're an essential element as we try to coordinate our approaches and our efforts. In December 2022, the Financial Reporting Council released Financial Reporting Exposure Draft FRED 82. I have to tell you things you know already as part of the introduction, so bear with me. This FRED outlines the proposed changes to Irish and UK accounting standards and forms part of the FRC's periodic review of FRS 102, FRS 105 and other standards, and this happens approximately every 5 years. Given that these standards are widely used across Irish businesses, the periodic review is an important stage in the evolution of accounting standards and allows us to consider whether the changes proposed are suitable and proportionate, and that the comment period, of course, for FRED 82 is due to close, I think, the 30th of April, isn't it? End of next month? Yeah, that sound right to you? Yeah, okay, thanks. The format for today's event, twofold. First of all, colleagues from the FRC, Jenny Carter, who's Director of Accounting and Reporting Policy, and Stephen Maloney, the Senior Project Director, Accounting and Reporting Policy, will be giving us a summary of the key changes proposed to the standards. Jenny and Stephen have been here before. It's very good to welcome them back to Chartered Accountants House. Thanks for making the journey. It's really good to have you here. Their presentation is going to last approximately 1 hour. It's going to be moderated by the chair of our Financial Reporting Technical Committee, Fiona Hackett, down here. Bear with me a second. I just want to acknowledge Fiona's work and the work of all our volunteers on our technical committees for the work they do on all of our behalves, just to ensure that our views and the views of the profession are made known to the regulators and decision makers. So we're going to do that for 1 hour. We'll do a little bit of a pause, and then at 2 p.m. for those who are registered, we'll have a roundtable discussion with Jenny and Stephen. I suppose the idea behind the roundtable is to permit a deeper dive into the topics and maybe give you a further chance to ask questions and discuss topics if you're registered. It is really great to have so many of you here in person. Your attendance today emphasises the importance, the relevance of the subject. We've also welcomed colleagues from IASA and from the Department of Enterprise, Trade and Employment who joined us at different stages over the course of the afternoon and participated in the discussions. Also to mention my colleagues Dee Moran and Michael Halloran for making all this happen, up to and including giving me my script. But I'm now very happy to invite Jenny to take the podium and start the proceedings properly. Thank you very much indeed.
Thank you, and it is great to be here again and see so many people here in person, so fantastic. Right, so we'll talk about FRED 82, which arises from the periodic review of FRS 102 and all the other standards. I'm sure you're familiar with them. And just a quick agenda here. We'll go through in more detail some of the particular amendments that are proposed, and obviously opportunity for questions and answers and things as well. So, quick overview of FRED 82. So we've got 6 FRSs, and we do a periodic review approximately every 5 years. And of course, the idea there is that we try and keep a fairly stable platform in between periodic reviews. It's not always possible. In fact, I don't think it's ever been possible. There's always something that crops up that's urgent and requires some sort of amendments to be made in between periodic reviews, but often they are narrow scope amendments, usually apply to only a proportion of those entities applying FRS 102 and don't have the scale of a periodic review. So we do the periodic review every 5 years as a sort of more comprehensive update. And although FRS 102 is usually the focus of it, there is the potential to update the other standards as well. And FRS 105, I guess, is subject to perhaps more update than some of the others, because some of the changes to FRS 102 will filter through into FRS 105 for micro entities. So this is our second periodic review. We started it in March 2021, which sounds like quite a long time ago now. So 2 years ago. And I suppose there's the question, you know, what's been happening since then? So we started with a call for views, and that was open for quite a long time, I think 6 or 7 months. But we've been doing a lot of work in the background as well, and thinking about what changes we might want to make. So as part of this process, the sorts of things we've been thinking about are changes to IFRS accounting standards, the changes that are proposed for the 3rd edition of the IFRS for SMEs accounting standard. So the IASB has been doing its second comprehensive review, also second review of the IFRS for SMEs accounting standard on a similar sort of timescale to us. And that has been quite interesting because they've been then considering some of the same issues that we've been considering. We haven't always come to the same conclusions, but it's certainly been interesting to see where they're going. And of course, where they have considered and come to a similar conclusion, there's potentially an international solution that we can use as the basis for our proposals as well. So thinking about the changes they're proposing, I think their exposure draft was issued, I think in September last year. The comment period ended at the beginning of this month, and obviously we'll be looking out for what happens next with that project. Another key piece of information that fed into this review was the stakeholder feedback. We got a good response to the request for views, and it covered sort of areas where people felt improvements could be made, but it also did give us, and Stephen will come on to this later, some initial views around some of those major IFRSs as well. So that was helpful input into the process. And the other key area that we thought about was other developments, sort of wider developments in corporate reporting. So one of the things we particularly thought about under that sort of heading was in the UK, there are proposals to change the definition of a PI and include more large private companies. And so we had a bit of a think about whether actually more disclosure might be required of some larger private companies. We decided it wasn't, so no changes are proposed, but it's just an example of sort of where other changes in corporate reporting might lead to things that feed into this process, even if at the end there aren't any proposals arising from it. So there are a lot of things inputting, a lot of things considered, and then we ended up with FRED 82 with our proposals for changes. That was published in December, and it's got in it, as you might expect from the things we were considering, proposals to update the requirements to reflect changes in IFRS accounting standards, and also some other incremental improvements and clarifications based on stakeholder feedback and other things that we'd considered as well from the last few years that have cropped up. The proposed effective date for the amendments is the 1st of January 2025. Of course, that is itself subject to consultation, and comments are invited by the 30th of April, so the end of next month. So there's still just over 4 weeks, I guess, to get comment letters written if you want to contribute to that. And comments, of course, are invited on all aspects of the amendments, including there's a consultation stage impact assessment in there. And we have set out some particular comments, but obviously people should feel free to answer only some of those, or to provide other comments depending on what views you might have. It is quite a big document, so just to give you an idea of what's in there, we've got a short overview at the beginning. There's the invitation to comment, which sets out the questions, basically. And then we've got the draft amendments to FRS 102 itself. That in itself is quite long, 184 pages, but it's grouped by section. And also what we've done is we've repeated, if we're making only perhaps even a couple of words change to a paragraph, we have repeated the whole paragraph so that you can read it in its context. Because sometimes, if you just sort of have a bit of a bullet point or something, it's harder to appreciate what we're actually changing or why without that wider context. So that can help to to lengthen the document, but hopefully also improve its readability. We did also issue a staff draft which reflects those changes in the main body of FRS 102, and this is another way of getting that context around how the changes will look. There's amendments to other standards, so that's only sort of just less than a third of the length of the changes to FRS 102, grouped by standard. Not very many changes to the other standards apart from FRS 105, where some of the FRS 102 changes are reflected and further simplified. There's the basis for conclusions, which sort of sets out the issues we thought about, why we're making certain changes, and in some cases, why we're not making changes that stakeholders might have asked about. So that might be interesting from that perspective, as well as the explaining the changes we are making. And then we've got the consultation impact assessment at the end. So quite a long document, quite a lot to get into, but hopefully quite well signposted. And if there are topics that you're more interested in than others, they should be quite easy to find. And Stephen's now going to take us through in a bit more detail, or in definitely more detail, the actual proposals.
Not too much detail. Thank you. Hello. I am going to provide some detail about these proposals, but I want to make sure firstly that we have plenty of time for Q&A before 1:30, and that we don't talk about everything now that we can otherwise talk about in the sessions later. So I'll probably try and keep it slightly lighter than it appears on the slides, but this is an overview of the amendments that are proposed in FRED 82. We've got two real headlines: revenue and leases. We've got the sort of next tier conceptual framework, fair value and small entity disclosure proposals, the latter of which is really a UK proposal, and there is an important difference between the UK and Ireland. And then other II and C, the somewhat mysterious acronym, which stands for incremental improvements and clarification, which obviously doesn't fit in my nice little hexagons there. So we'll take a little tour through those main areas and then make sure we have time for questions. So first of the big headlines, revenue from contracts with customers. What are we proposing to do? We're proposing to rewrite section 23 of FRS 102 to align it towards the 5-step model from IFRS 15, revenue from contracts with customers. We are also proposing to rewrite the equivalent section of FRS 105, the microentity standard, on the same principles, but in each case is with what we consider to be appropriate simplifications to make them proportionate for the community that apply FRS 102 and FRS 105 respectively. FRS 103, which is the insurance contract standard, is also proposed to be amended because FRS 103 and its implementation guidance talk about how you apply the principles of section 23 to insurance contracts. So of course, if we change the principles of section 23, we need to make some changes to 103 as well. So that's the gist of why are we proposing to change this? I think it's important to bear in mind that before the international standards on revenue and leasing changed in 2018 and 2019, we were more or less aligned. And so in some respects, this is about re-establishing alignment with international standards that we did previously have. But it's also about the benefits of those international standards. So the 5-step model that's in IFRS 15 was intended to provide a single comprehensive framework for revenue recognition and ultimately to provide more useful information to users of financial statements. And fundamentally, we think that's a good thing to try and do in FRS 102 as well. It's been around for a while now in IFRS. It's been effective since the 1st of January 2018. So there's been time for people to get used to it and see how it works. And the feedback that we got from the request for views that Jenny mentioned was generally supportive of the idea of aligning towards that new model, as long as it was done in a proportionate manner. So ultimately, we think that this would result in more reliable reporting and also increased comparability between entities. And that means both between entities doing FRS 102 and those doing IFRS, but also hopefully between different FRS 102 preparers by providing that more consistent framework for making decisions about revenue recognition. Why do we want to extend that to micro entities as well? I hear you all asking. It's really for the same reasons, and it's the principle that if we can achieve a single comprehensive framework for revenue recognition across all the frameworks in use in the UK and Ireland, that there should be benefits from that, and everybody gets the the same fundamental comprehensive up-to-date model for their revenue recognition, also we are able to make it proportionate by making further adaptations and simplifications within the context of that model. I don't know what level of detail I'm going into here. I'm probably going on too long, so I'll go quickly over this one. But this slide on the left-hand side, we're showing some of the ways in which we are trying to make that IFRS 15 model proportionate for FRS 102 preparers. In doing this, we've been we've taken a lot of inspiration from the proposals for the IFRS SMEs accounting standard. So you'll see that both we and the ISB are proposing quite similar changes to rewrite section 23, to align it with the principles of IFRS 15, to structure it around the 5 steps of the 5-step model and so on. But we have also made further changes compared with what the ISB is proposing in their exposure draft. So those who are particular enthusiasts for how all this fits together, there's plenty of things to look at to understand that. I suppose the main point to note, the word that comes up many times on that left-hand side there is simplified. There's various things that we're trying to simplify, and we can talk about this in more detail later. And then for FRS 105 preparers, well, the word that stands out there is removal. So basically, having simplified things for 102, we're then basically saying there are a number of concepts in here that most 105 preparers probably don't need to worry about. So we're just saying, well, let's strip those out. Let's try and go back to the fundamentals of that 5-step model. So we can come back in more detail in Q&A or later on to that, but that's the gist of it. Turning to lease accounting, again, the what and the why, there's some similarities here with what I've just said. So what we're proposing is to rewrite section 20 of FRS 102 to align us towards the on-balance sheet lease accounting model for IFRS 16, again with appropriate simplifications. Importantly, we are not proposing that in FRS 105. So there is no proposal in FRED 82 to bring operating leases on balance sheet for micro entities. There is also an important difference here from the IFRS SMEs proposals because the ISB decided not to attempt on balance sheet lease accounting in the IFRS SMEs at this point. They haven't said they're not going to, but they aren't doing it at this point. So we are forging ahead of them there, and we think there are good reasons to do it. So why are we proposing it? Well, again, it's realignment with IFRS. The IFRS 16 standard has been effective since the 1st of January 2019. So again, it's been there for a while. Why does it exist? It's to provide a more faithful representation of leasing transactions and provide more useful information to users, and results, as you probably know, in lessees recognizing assets and liabilities for most of their leases. So fundamentally, we think this is a good thing. We think it's good for preparers to recognize these things on their balance sheets, and the feedback from the request for views was generally supportive, albeit admittedly with a strong message that there were aspects of IFRS 16 that needed to be simplified to make them proportionate for FRS 102. And we think we have achieved that, and we of course look forward to what people say in response to the consultation. So ultimately, this is expected again to result in more relevant and improved information to users, and again increase comparability between entities. And this slide again is setting out some of the ways in which we've tried to make that IFRS 16 model proportionate for FRS 102. And just to pick out one or two of the things on this slide, discount rate is the single area in which we heard that people have most problems with IFRS 16. And as you remember, IFRS 16 asks you to use the interest rate implicit in a lease as your discount rate for determining the liability. And then it says, if that's not readily determinable, and people say, well, it usually isn't readily determinable, then you use an incremental borrowing rate. And it tells you what an incremental borrowing rate means, and what kinds of things have to be taken into account. And everybody says, oh, that's not much easier to do. That's still quite difficult. So we've tried to offer simplifications by adding another 2 discount rates to the way it works. So there's a choice of either using an incremental borrowing rate or what we are calling an obtainable borrowing rate, OBR, which is effectively still a borrowing rate, but one that should be easier to determine. And in the exceptional cases when neither of those is readily determinable, there's an option to use a gilt rate, a publicly available gilt rate, as a backstop. That has some drawbacks from a sort of economic purity perspective that a number of you will have noticed. But the fundamental point is that it's firstly, for exceptional cases, and secondly, means that nobody should be prevented from doing the accounting because they cannot determine readily a discount rate. There are other areas in which we've tried to offer simplifications. Again, we can talk more about those in Q&A. But effectively, we've been through IFRS 16 and we've looked at, based on what we've heard and based on our own views, where is there scope for simplification? And important to note that we've tried to make those simplifications optional for the most part, which means that if you've got an FRS 102 preparing entity, which is doing group reporting under IFRS, so they're already used to doing IFRS numbers, there shouldn't be mandatory gap differences. So effectively, they should be able to do very, very similar accounting for both their IFRS group reporting and their FRS 102 lease accounting. And that also translates into the transition options. So we're proposing that if you've got IFRS 16 numbers from group reporting, you can use those as your opening balances on transition. Moving on, some of the other areas, those sort of next tier areas, we are proposing to rewrite section 2, which is concepts and pervasive principles of both FRS 102 and FRS 105. And this is to reflect the IASB's 2018 conceptual framework for financial reporting. With simplifications, again, compared with what the IASB has written, both in the conceptual framework itself and in the IFRS SMEs proposals. Why does this matter? Who even ever reads section 2? I hear you ask. Well, there's sort of two purposes to section 2, really. One of them is to set out the foundations and the frameworks which underlie the future development of the standard. So it's to set the concept, set the language that will be used in future development of the standard, but also in cases where preparers need to develop their own accounting policies, perhaps for an unusual transaction that isn't covered by the standard, it's to give them the tools to do that. And by aligning with the 2018 conceptual framework, we can help to maintain consistency with the international solutions. And nearby in the thread, we have fair value proposals in a new section 2A, fair value measurement, to replace the appendix fair value measurement to section 2. Now you will notice that this means I don't have to change the paragraph numbers because what used to be 2A.1 is now 2A.1, but that's not the only reason. The key thing here is that we are revising the definition of fair value based on the one from IFRS 13, providing more comprehensive guidance on fair value measurement, which should, again, assist in applying these fair value concepts. There are certain things that we're retaining that we think are useful from the existing appendix. And again, compared with the IASB's proposals, which involve including a lot of disclosure requirements in the fair value section, we aren't proposing to do that. We're basically leaving the disclosure requirements as and where they are through the rest of the standard. Why are we doing this? Well, again, it's moving to up-to-date definitions. It's maintaining international alignment. But we also think it's useful to have greater guidance around fair value and put that guidance in a clearer context. And the third of my second tier amendments, my fifth of 6 hexagons, if you're counting, is what are we doing about small entity disclosure requirements? And from a Republic of Ireland perspective, the answer is we're not doing anything. So why am I talking to you about it? Well, because the slide was in there anyway, you know, I just switched it around to put Ireland on the left. It's worth thinking about the current requirements for small entities. So section 1A of FRS 102 says, if you are a small entity as defined in the relevant jurisdiction, the disclosure requirements that apply to you are different. And the overall requirement is that you have to give a true and fair view in your financial statements. But because of the operation of the EU Accounts Directive, there is only a very short list of specific disclosures that we can specifically require you to give. And so you've got this overall objective that you have to give a true and fair view. You've only got a short list of disclosures that you have to give. And then individual preparers are left to exercise judgment to determine which additional disclosures from sections 8 to 35 they need to put in. To help them with that, we've got an appendix E to section 1A, which encourages certain disclosures, which we can't require, but encourages people to give those disclosures. So we list the legally required minimum disclosures in Appendix D for Irish entities, and we encourage them to give the ones in Appendix E. What's changing from an Irish perspective? Nothing. Thanks for coming. But worth being aware from a UK perspective that we are proposing a change, and that's because we are no longer restricted to that very short list of specific disclosures we can require. We are proposing to lengthen Appendix C, in this case for UK entities, and say, well, look, in order to give a true and fair view, as well as those legally required minimum disclosures, we also think you really, when relevant, need to provide the following disclosures, and that includes disclosures around provisions and contingencies, disclosures around share-based payments if you have them, and certain difference disclosures and so on. And because we no longer need to encourage, because we can now require, UK entities no longer apply Appendix E. So that, although that doesn't have any direct impact on Irish entities, it might be of interest as a comparison. The intention from a UK perspective then is that we reduce the amount of judgment that those UK small entities have to apply in order to get to a true and fair view. Other incremental improvements and clarifications. What is being proposed? I always get the order of the words wrong on this slide to make it really work. What is being proposed around expected credit losses? Nothing for now. So this was the third of the three major new IFRS accounting standards that we considered. We talked about IFRS 15 and 16. The other one that we'd flagged in advance that we were going to think about was the expected credit loss model of financial asset impairment from IFRS 9. And the conclusion we reached for the purposes of FRED 82 was that we had no proposal to make. That does not mean that we've decided that there will never be an expected credit loss model in FRS 102, but it means that our own views and the views of stakeholders that we heard from were that it wasn't the right time to try to bring that in to FRS 102. Why is it not being proposed? Well, stakeholder feedback was quite strong on this point, I would say. There were views that it was a bit too soon. There's also the fact that we prefer to follow an IFRS-based solution where possible, and there isn't yet a clear IFRS-based solution to this. The IASB is proposing an expected credit loss approach in the IFRS SMEs accounting standard, third edition. The approach that they are proposing wasn't necessarily one that we thought was appropriate for FRS 102, and we would quite like to see where they end up, basically, when they consider the responses to their consultation when they finalise that third edition. So we do intend to reconsider this one later, taking into account where the IASB ends up, but partly to show that we're serious about it and partly to get more feedback. One of the questions in that invitation to comment is specifically about this. So although there are no proposals around ECL in FRED 82, we do ask a question about it, and we're inviting feedback on effectively whether an expected credit loss model should be applied by particular entities or whether it should be applied to particular assets, the latter of which is the IASB's proposal. And if people think it should be by particular entities, which entities, where do they think the line should be drawn? We've done a certain amount of thinking and discussion with stakeholders on that in the course of deciding what not to put in FRED 82, but we're really interested in more feedback. So I'm raising that because it is in the ITC, it is an area that we're interested in. And of course, the IASB is kicking off its post-implementation review of these requirements of IFRS 9 as well. So we should be better informed on this in the unspecified future. Selected highlights from the other incremental improvements and clarifications. Again, we'll have time available to talk about these later on as well. There are new disclosures proposed in section 3 around the application of going concern basis. We are proposing to remove the option in sections 11 and 12 to follow the recognition and measurement requirements of IAS 39, except by those who are already doing it. So for now, if you're already doing it, you can carry on. But we've said in the past that when we get to an answer on the expected credit loss topic, we do intend to remove that option entirely. So it's moving us towards that. We've got a number of things in section 19, which is the business combination section. We aren't proposing sort of general alignment with IFRS 3 in the areas where we're not currently aligned, and we aren't currently proposing, for reasons that I can go into if anyone's interested, to align with the latest definitions of business and business combination. But there are some additional things that we're proposing. So we've got a new appendix giving guidance on identifying the acquirer in a business combination. There's additional emphasis on the importance of distinguishing between consideration and remuneration, and some additional disclosure requirements about business combinations. Section 26, which is share-based payments, there's a couple of additional bits of guidance and requirements around measurement of cash settled share-based payments, around accounting for share-based payments with cash alternatives. And these are examples really of things that have come fairly directly from the stakeholder feedback and the request for views, where people have said, we think there needs to be more on this. And we've looked at it and said, yes, we think we agree. Similarly, section 29, which is the tax section, people asked for the guidance from IFRC 23 on uncertain tax treatments, and so we're proposing to put that in. That is, I appreciate, a bit high level and quick on some of it, but hopefully giving us time to come back to things people are interested in later. And I will hand back to Jenny to remind us what the next steps are.
Thank you. Yeah. So we're still in the first box on this slide, the consultation phase, public consultation running. It came out in December, but I don't think anybody was going to be writing a letter, maybe the first few days. So largely in this January to April period, with the comment period ending on the 30th of April, as I mentioned earlier. And then, of course, the next thing that happens is that we'll be redeliberating on those responses, and I suppose the time that will be needed for that will depend a little bit on, or maybe to a greater extent, on the number and nature of the responses that we receive. And then we'll be issuing the final amendments, and we're hoping to be able to do that by the end of this year. But as I say, that does, is dependent on to some extent the responses we get. And then, of course, it's over to you to implement, and we will give entities not less than 12 months. The precise amount of time will depend. The usual approach is to have a 1st of January effective date, so the precise amount of time depends on quite when the amendments are issued, but there'll be not less than 12 months, as we do want to give people time to properly implement. And then the proposal that we have is for the effective date to be the 1st of January 2025. Of course, as I said earlier, I think that itself is subject to consultation, but we thought about it, and for a number of reasons felt that that was an appropriate effective date for the proposals. And I did mention earlier as well the invitation to comment. So despite the number of proposed amendments, there's actually fairly few questions. There's just 10 questions. And what they tend to do is focus on a key issue. So you can see many of the topics that Stephen mentioned are there as a question, including the question about the expected credit loss model that we're not proposing. And there is, of course, the option to just provide any other comments that you have. So we've targeted the things where we particularly want feedback, but feedback on the whole document, of course, is welcome by the end of April. So we'll look forward to that. And if you want to look into any more information, there's a lot of information there on our webpage. The address is there. There's the FRED itself, of course, the staff draft that we mentioned, various other supporting documentation, podcasts, webinars, etc. And any responses received to date are there as well. Yeah, there's the email address to send comments in by 30th of April. So we look forward to that.